investors, I'm Stuart Cruz, founder of Cruz Asset Management. We're a boutique asset management firm where we make our investment choices based off of math and statistics. That way we think you have a better odds of outperforming the market when the odds are in your favor. Kind of moneyball finance, if you will. So today's topic is reducing the risk of your portfolio. So I had a client that called me and said, we haven't even had the meeting yet, called me and said, I want to take out the risk of my portfolio. And that, of course, is a conversation you should always want to have if the client is feeling like they're taking on too much risk. But in this particular case, because of the rhetoric that's coming out of the current administration, she felt like the risk was elevated. Her risk profile didn't drop. She just felt like the risk in the world had risen. Now, what I would say to you is you pretty much always have risk going on, whether it's perceived that there's high level risk or not. Whether you like the current administration or don't, there's always a high level of risk when you're invested in the stock market. Now, sometimes the stock market doesn't necessarily reflect that in that it continues to go straight up. But somewhat ironically, in this particular case, the administration itself was kind of the focal point, and yet the same client wanted to get out when the president was elected, but the market has done nothing but go straight up more or less since then. Now, this is not a political statement. I'm certainly not trying to say that I am for or against the administration. I'm just trying to say that agnostically, as an advisor to somebody's portfolio and future financial health, we need to look at the situation at hand and how it's going to affect us and what are the best moves. So again, we like to use math and statistics in order to make our moves, and we can help you with that as well. So for instance, if you have a 401k plan at your current employer and you're not quite sure when to get in and out of particular mutual funds, we're going to show you a nice neat trick that will kind of take the guesswork out of it. Should be able to improve your returns and reduce your risk. Because let's face it, no matter when we're looking at it in history, there is always risk. So whether it's the current administration that you're for or against, or the previous administration that you're for or against, about half the country is going to be dissatisfied with the current administration, and you're going to have feelings of unease about your portfolio. But there's always risk associated with it. It doesn't matter if two big investment banks like Bear Stearns and Lehman Brothers are going out of business, or whether another country is defaulting on their bonds like Greece, or whether there's some other activity like terrorist attacks or other rhetoric that's been elevated in the news. There's always risk in the stock market. High oil, pick your area. The media will cover a topic in order to generate activity so that you're interested to tune into the media. But there will always be risk per trade in the stock market. So we're going to show you some nifty tricks. It's not necessarily the best case to just kind of feel your way through this. So we're going to show you historically what are the best times to reduce your risk and why. Okay, so tune in. We're going to take a quick trip over to my computer and we're going to see the desktop. So thanks, and I'll see you over there. Hey investors, all right. Thanks so much for joining me on my desktop here. So we're going to talk a little bit about some of the signals that we use to help reduce the risk, because there's always risk going on in the market. Whether the administration is in your favor or not right now, or whether there are other issues going on within the stock market in this country or out of this country, trade war with China, Greece defaulting on their bonds, terrorist attacks, doesn't matter. There's always risk going on in the stock market, and certainly the media outlets are going to portray that there is a lot of risk. So some of the signals that we use are very long-term signals because we don't want to promote a lot of trading, but we also want to make sure that we miss big drawdowns. So this is a chart of a 10-month candle chart. I'm sorry, single month candle charts over 10 years. And what we'll do here is, if you follow me along, this line underneath the candles here represents a 10-month moving average. So at any given point, this is just the average of the previous 10-month candles. So if the current candle is above the 10-month moving average, that's bullish. That's in favor of the stock market. If it falls below, that's bearish. Here is a moving average convergence divergence, or MACD as you call it. And the histogram of that says Whenever it's positive, that's bullish. Negative is bearish. And then here is a stochastic. So a lot of these are momentum indicators, and then when you're above the 80% line and or moving up, that's bullish, and then below the 80% line moving down, that's bearish. So we're looking for all three of these indicators to be in one favor of the other. If they're all in sell, we sell. And then once we're in sell mode or out of favor mode, we have to wait for all three of them to be buys before we get back in, and vice versa. So for instance, here we are where you're above the 10-month moving average, the histogram is green, and the stochastic is above 20% and going positive. So this is in favor and a bull market. And here we are moving along, up, 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 up. And even though we get some red MACDs down here, we stay invested because we're still above the 10-month moving average, and this has not turned negative and is not below 80%. So we still stay in until basically here, where we're below the 10-month moving average, we're still red here, and we've fallen out of favor in the stochastics. So this was almost a full year before all three favor signals showed us to sell. And then another, again, keep in mind, these are each 30 days or a full month. So we are out of the market here, 2, 3, 4, 5, 6, 7, 8, maybe 9 months. And then we get back in. When finally we're above the 10-month moving average, we have a green MACD, and then the stochastic is positively sloped. But again, we've missed this volatility. You see how it's a lot more choppy through here? And now we have a nice smooth upward run. Looks like maybe we should get out right here, but we never finish below the 10-month moving average, even though this is red. The stochastic is well above 80%, so we don't get out, and we participate in this upside. But here we get out. And we're in for this, but we missed this big drawdown. Good for us. But here's the painful part. We stay out even though we have a big run up, and we're still out to this point. So we missed this volatility too. At some times you're going to have to get back in a little higher than when you got out. It does not work on every trade, but over the long term, where it really helps is in reducing risk on big drawdowns. So I'm going to show you JNK, which is the ETF for junk bonds. So as you can see, well, we'll look at the very end of the chart. Obviously, this was moving up, and this is very green, and we're moving up. So you would have participated in the junk bonds all the way up to here until we get out right about here. And then you can see we kind of go up and down, so we're probably in and out here. And as long as we stay disciplined, we probably didn't make any money on this asset class. We made it here, probably got in and out a couple times, but here, when we're below the 10-month moving average, the MACD is red, and then this stochastic turns downward sloping, we get out. And while we might not get out at an ideal point, look at the downside that we miss. For over a year, we miss all this downside, that we don't have to be in that particular asset class or risk our capital there. Now, conversely, we do miss some of the upside. So let's say we get out at around 120. The market goes down to into the low 90s, but we don't get back in until 105, but we still missed 15 points of downturn. And that's very worth it. And we missed all this volatility and heartache. Yes, this might have been a difficult period to be out of, but at the same time, we made ourselves 15 points. And that's where the beauty of this particular investment strategy works. So we can look at one more thing. Let's look at the IFA. It's international stock market, where the international stocks have gone kind of back and forth, back and forth. We made a little money here as the market goes up from 60 up to 70. So that's a nice return, 12%. But it drops off, and we're below the 10-month moving average. The MACD turns red, and the stochastic turns negative below the 80% line, and we get out. And we got out in May, and the international markets sold off for the rest of 2018. And so we missed this drawdown from, call it 70 points, down to 55. So we missed another 15 points because of that that strategy. We did miss the upside as well, so we are now looking at still a net positive of getting out much higher than we would be getting back in. But yet this MACD still hasn't turned green yet, and we are now seeing weakness. And so if this continues to go down, maybe there's another leg down. So we want to stay out while we can. So what does that do for us? So we can eyeball this on the chart. I can kind of pick just about any chart and kind of say, you can eyeball it and say, ah, that kind of makes sense. Here's the emerging markets. And you can kind of see a very similar situation where we're in and we get to participate in this huge run up, and then we get out and we miss this huge sell-off, which is great. And here we would have gotten out maybe here, because that's red, downward, and we missed that sell-off, and we miss a lot of this volatility. So we keep out of miss a lot of this volatility, and we don't get back in until the market trend is established. Okay. So what does that do for us? Well, let's take a look. Maybe we can move this over to here. And what we're looking at now, see if I can tighten this up a little bit. We're looking at a chart of Excel spreadsheet of 10 investments. SPY, which is the S&P 500. IJR, which is small caps, the iShares small caps. EFA, which we looked at the other chart. The emerging markets, which we also saw. Bond index, high yield, treasury, inflation protected notes, convertibles, real estate, and gold for all you gold bugs out there. So there are 10 asset classes there. What this does is say we're going to take 10% in each asset class, and we're going to build a moderate, or what I would call conservative to moderate portfolio, because we only have about 40% in equities, 40% in fixed income, 20% in alternatives, and some of those alternatives are gold. So I would call that a moderate or maybe even moderately conservative portfolio, because only 40% are in equities. So you have all these little individual lines to show you how things went from 2007 through 2019. And even in this moderately conservative diversified portfolio in 2008, our drawdown was over 36%. So you're saying, okay, I wanted a conservative portfolio and I'm down 36%, or moderate portfolio, still down 36%. It's not what my client wanted. Remember, my client said, I need to de-risk my portfolio. So another strategy that people use is a just straight bond, and actually most clients will see a just straight stock and bond portfolio because that's what they're familiar with. So we only had 40% equities here. Let's look at a 40% stock market, 60% bond portfolio. Let me click back over here. This return, $192,000. We started at $100,000. So on this one, again, starting at $100,000, we end up with 196. A little bit better, okay? About 2% better. So that's not bad, but you're basically looking at $4,000 over 10 years, so it's marginally better. But what is very good is this lack of drawdown. So the drawdown's only 21%. Now I say only 21% because if you're a moderate or conservative, moderately conservative client, and you had a portfolio worth $1 million, and now you're at $780,000, you might feel like you have to keep working. So losing that $200,000 is not really a moderately conservative position, and I think this is exactly what the client's afraid of, is this big drawdown. So think they have a moderate position, and when the whole world comes crashing down on them, they still lose a boatload of money. And this, you don't normally even see a 40-60 split. You see a 60-40 split, so 60% equities, 40%. And if that were the case, then that's barely moderate. I built this to be able to change this quickly. So if I change that to 60% equities, what you see on this chart is now your drawdown gets to be 32%, back to where it was before. So again, that's a big number. Even though I'm only 60% equities, and maybe a moderate portfolio, you have a humongous drawdown. Now you do have higher returns, $200,000. But I think we can do better. So let's see if we can do better. We use the three signals, which, by the way, I've tested this over and over and over again. When I first found out about this kind of strategy, I built my models immediately and tested different indexes and international and different modified or different portfolios and different diversified portfolios, aggressive, moderate, conservative, every way at different time frames. The trades don't work on every trade, but if the odds are in your favor, just like in Vegas, the more trades you place like that, the more chances you have, or the odds are better that you are going to win over the long term. Because remember, the house doesn't always win. The house always wins over the long term. If the house won always, you would not play. The house wins most of the time, just a little bit over half of the time. You get to win the other half. So if our odds are slightly in our favor, we want to play with the strategy more and more and more so that, and take and use every asset class that we can available so that the odds shift more and more into our favor. So we just saw the two strategies. Let's send this back to 40%. Okay, great. Let's look at our chart. Okay, so here we have two strategies. Diversified strategy with 10 different asset classes. More typical one with just the two asset classes and less drawdown. So might say, hey, why do we even need all these asset classes? And maybe we don't. But let's look at the three signal strategy, incorporating all 10 of those asset classes. And this tells us, not by my gut or my feel, not by what I'm hearing in the newspapers or by what Donald Trump is saying or by what some economist is saying about whether I should get in or out of high yield bonds or gold, but it gives me an actual actionable item about when to get in and out. When you do that, let's just look and see what we have here. It's not really what I wanted to show you, so I'm going to cut this out a little bit. What this chart shows you is, okay, so when we do that, we have this chart here that shows you the same chart before, only this is just a little cleaner. 36% downturn, 192% returns. That's what we have. Okay, let's see if we can zoom in on this. This is new technology for me, so I'm going to try and zoom in. I don't know if I'll be able to. Maybe not. Okay. Nevertheless, we have this chart, and we are going to add onto it our 40-60 portfolio to see how that shapes up. And here we have our slightly better returns with less drawdown. That is very attractive. Okay, so but still probably not what my client's looking for in a reduced risk scenario, and she still needs to make money for her retirement. Like, she doesn't want to bury her head in the sand, right? So if we add our three signals onto this chart, what we end up with is a chart that looks like this. You have much greater returns. So instead of going from $100,000 to under $200,000, we're almost at 2.5 times our money. So significantly more, like almost 30% more. But even better, our drawdown is not 36%, it's not 21%, it's 12.5%. So your $1 million portfolio is still up in the upper $800,000 after what seems to be like a humongous world-ending event. And keep in mind, that drawdown, if we look at this chart, is well above, like at that point when that drawdown happened, they're basically just barely back to even or slightly above, and we at this point are way ahead of even. So even when that drawdown comes, we're already 40%, made 40% on our money versus the 10 or 12% that they've made when they've had to go through the big sell-off of 36 or 21% respectively. So for somebody who's conservative or moderately conservative or concerned about the current risk in the environment, this 12% should be tenable for them. They should, if it's not, then we need to have that conversation. But if they're moderate or moderately conservative, and they should be able to withstand a 12% sell-off and still be fully invested. And we get to participate in the upside. And the reason why this works so well is when the market turns south, we don't participate in these downturns. We know when to get out. This happened a couple times. So 2008 is the obvious one, but it happened again in 2015, where you can see we went flat, we stayed out, but we're able to get back in. And we get to ride from a higher base. So we missed the downturn, and if we can get back in a little bit higher, then we can build off of a higher base and participate in the returns. So this is hugely beneficial for our clients and more in line with their risk. And it's not the same old buy and hold strategy that you have for most of your brokers that says just write it out. And it works. So you can use this in your 401k plan as well. So you have a handful of mutual funds in your 401k plans or some ETFs, and you don't know which ones to use, why you should use them, when you should buy, when you should sell. Use this simple strategy. 10-month moving average, convergence, divergence, and stochastic. And when you get all three sell signals, get out of that mutual fund. All three buys, time to get back in. Okay? And then over the long term, you won't have to ride that 401k down to half of what it was before. So there you have it, a way to reduce your risk, improve your returns. This actually made this portfolio 78% more efficient. So about 30% higher returns. The drawdown was about 2/3 less, which is amazing. And the volatility, what's usually measured with risk, was I think somewhere in the neighborhood, let me see, I'll probably have this data up here, was in the neighborhood of 20% less volatile as well. So overall, 78.5% more efficient portfolio. And that's what we want to do. We want to look for better efficiency. At the end of the day, you don't really care about the efficiency of your portfolio. That reduces the stress on you, on your retirement. It reduces the stress on your portfolio and the legacy that you want to leave for your family. It reduces your stress about worrying about whether this administration has your best interests at heart, or whether oil is going to pop, or whether there's going to be something that we're not aware of, and it's not even on our radar. But if the money's moving in or out, then we follow the money and we make the changes accordingly, according to the statistics, not according to what my gut says or according to what century-old thoughts are on buy and hold. Okay, so I appreciate you watching. Thanks so much for staying tuned. If you want to reach out to us and find out more about how we manage our portfolios, you could actually get into this moderate portfolio through a platform called Motif that we have. It's automatically managed for you. So reach out to us at cruiseassetmanagement.com, Kruse, assetmanagement.com. You can find us on Facebook at cruiseam.com, LinkedIn, same thing, cruiseam.com. And thanks for watching. And any ideas that you have about other videos, you want to see the math behind the other videos, that's what we do. Hey there, thanks so much for watching our video. And because you made it all the way to the end, we're going to offer you a free portfolio evaluation. So click on the Riskalyze link below. That's a 7 to 12 questionnaire that will numerically evaluate the risk that you're willing to take on. And let's see if it's in alignment with your current portfolio. And if it's not, it's probably a conversation you need to be having with an advisor. Thanks again, and I look forward to seeing you in your next video.